Is the US stock market in a bubble? Warren Buffett tends to think so. For myself and my clients, we use educational resources from some of the smartest minds all across the country and all across the world. And one of the indicators and one of the resources that we use is what's called the Buffett Indicator, which gives us an idea of what the stock market is like. So let's take a peek at that. So this website is, like I said, called the Buffett Indicator. And right now it is suggesting that the US stock market is strongly overvalued. Now this website is free to use and is simply, I just searched the Buffett Indicator and it came right up, but it looks like it's currentmarketvaluation.com. And as you see here, they use this formula that takes the total US stock market value and they divide it by the GDP, or the gross domestic product. And as of the end of 2024, the Buffett indicator showed a 211% ratio. And now this ratio fluctuates over time since the value of the stock market can also be very volatile, but GDP tends to grow much more predictably. The current ratio of 211% is actually approximately, let's just call it 67%, or about 2.2 standard deviations above the historical trend line, suggesting that the stock market is strongly overvalued relative to the GDP. But why does this matter? This indicator expresses that the value of the US stock market in terms of size of the US economy, and if the stock market value is growing much faster than the actual economy, then it may be in a bubble. So what's very interesting about 2024 is that there was actually seven main stocks that carried the market, that carried the S&P 500 to have over a 20% return. And those seven stocks are referred to as the Magnificent Seven. And the Magnificent Seven are a core group of about seven stocks, or of seven stocks that were highly, highly profitable in 2024. Now, this takes into effect the entirety of the US stock market. And if we scroll down to here, there is a graph that I really, really like as we get past these ads. Here we go. This historical trend chart tracks the other times that the stock market was this overvalued. And if we look back into time, the last time, and actually you can see where we are right here, at once again, about 2 standard deviations over the historical trend. Now, the last time we were at this point was, it looks like about 2022, which if you guys know anything about the stock market in 2022, and I'll look it up. S&P 500 2022 stock market return. It was down about 18%. Okay. So the last time it was at this point, we had a stock market crash of 18% in 1 year. If we look back before that, you can see 2008 was another huge market crash, but it was not because it was a bubble. If you guys remember, the 2008 crash was referred to as a housing crisis. And that was because of simply just variable rate mortgage loans that caused that crash. It wasn't so much due to the stock market being overvalued. But the last time, prior to 2022, that we were actually at this two plus standard deviations away from the historical trend was back in the year 2000. And in the year 2000 was the start of the dot-com bubble crash, where the stock market was down 3 consecutive years from 2000 through 2002. Let's go ahead and just pull up the data and the research here. This Macro Trends website shows, here we go, the historical change in the market by year based on a percentage. Here we go, from 2000 through 2002, there was a 10% loss in the year 2000, a 13% loss in the year 2001, followed by another 23% loss in 2002. So if you look, the last time we were at these levels prior to 2022 was in 2000. So each time we've tend to hit this, this standard deviation, or being 2 standard deviations above the trend, there's been a huge correction and a huge market crash. So with that, what should you do and what could you do, right? So number one, risk in the market, risk in the stock market is not necessarily a bad thing, but too much risk, being too close to retirement, could be. So my first question would be, number one, how close to retirement are you? And if you're within about 10 years to retirement, that is when you should take this market risk very, very seriously. Reason being is that it can take on average about 7 years to recover from just one major market crash, as it did back in the early 2000s and in 2008. So if you are very close to retirement, that should be a concern for you. And now, if you're not so close to retirement, not that this doesn't necessarily have to concern you, but just know that, yes, you could have time for the market to come back up and to rebound. And now, at the time of this recording, today is technically March 12th. And so if we actually go back and we go and look at the stock market and we look to see just what's been happening in the last few days, today it's barely up, but the market actually just opened as well. But over the last 5 days, or here if we just look at over the last month, dating back from February 12th to March 12th here, the S&P 500 is down almost 8%. If we're looking at just year-to-date numbers, if we go back to January 1st, we're at about a 5% downturn so far to start the year of 2025. So we're starting to see a little bit of corrections and a little bit of declines in the market. So I encourage you, check on your retirement accounts. See how your accounts are doing. And if you want to have a conversation to chat about and talk about retirement, that is what we do here at the Wealth Academy. We help you retire smarter and retire better and take the risks off the table, because we believe that retirement should be as risk-free as possible. And we do that through multiple different ways, multiple different variations. Now, full disclosure for this video, I am not an investment advisor. This video, all of my content is purely for educational and information for you, but we do have certified financial planners, investment advisors, and so forth on our team. I specialize in safe retirement strategies, and so I don't put my clients' money in the market, but there is a point in, proper diversification that you should have some money in the market. But if you'd like to have a consultation or a conversation about retirement, and if you want to learn more about how we may be able to help put some protection and some safety into your retirements, that is what I'm for, and that is what our team can help you for as well. So below this video, you should see a link to thewealthacademy.com. Academy is spelled with a K, so make sure you get it right. And then on there is where you can book a time to chat to see if we can help, or just to see if there's any ways that we can kind of take some risk off before you do get to retirement. And before you guys go, make sure to like and subscribe below, as I will be posting a lot more educational content about retirement, about protecting and preserving your money, and about different ways to build wealth safely. We'll see you guys on the next video. Take care.